Over the last week in the S&P 500, Nvidia continues to climb up 1.5% amongst other large growth companies like Microsoft, like Apple, Google, and Meta. At some point, this growth will have to slow down. This is a company that is up nearly 200% over the last 12 months, yet we do have an indication from Wall Street that they still consider this company a very strong buy. When we took a look at this company in the latest valuation model, we got our intrinsic value at just under $140. Remember that this was on the free cash flow assumption of 30% over the foreseeable future. What this essentially leaves us with a margin of safety of around 5 to 10%, and Wall Street, who continue to revise their price targets, $140 as of this morning, with upside of 9%. Now in today's episode, we are looking at 8 stocks that have a lot more upside from Wall Street over the next 12 months that, based on their estimations, will outperform this company. The first one that we are looking at is Chevron Corporation. Now, we do get a double buy signal from Seeking Alpha and Wall Street, although we do note the hold from Quant. It is trading in the mid to lower end of the 52-week range with a forward yield of 4.23% and a forward P of around 12.04. Now, for those that are interested, S&P right now sitting around 23 forward looking, and over the last 12 months, Chevron is down around 1%. Over the last 10 years, however, we do note it is up around 20%. All-time highs that we can see around 2 years ago, just under $190. Now, when we take a look at this company's dividend safety, it does sit at 90, so it is very safe, always nice to note. And they have increased their dividend just this year at under 8%, very positive, as we always want to see a minimum of 4%, which is that inflationary target over the historical performance. In terms of the valuation for these companies, well, typically on our deep dives, we run through every single one of these models, explaining all the inputs and outputs. Today, jumping straight in, our value comes to around $181. With that current trading price, as always, a minimum 10% margin of safety is what we look at. We use that if we believe it meets the 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, it is a buy up to $163. Then we keep going till it's near that current trading price. Today's episode for Chevron, we see 15% at that MOS. As we can clearly see, Wall Street do consider this a buy, $190 price target, and based on their own estimates, this will outperform Nvidia over the next 12 months. Now, before we move on to the next stock, just to let you know, earnings season is upon us, so we may see a lot of volatility. We will cover the majority of these on the channel. As we can see, some of the big names that are coming this week, we have PepsiCo before the bell on Thursday morning, and we have a few large banks that are essentially reporting on Friday as well before the market opens. The next stock that we're looking at then is UnitedHealth Group, and we can see a buy from Seeking Alpha, a strong buy from Wall Street with a hold from Quant. We can see this trading in the mid to lower end of the 52-week range with a forward yield 1.72%, forward P just under 18, and over the last 12 months it is up 3.5%. Over the last 10 years, up nearly 500%. Bear in mind, it doesn't include dividends reinvested, and you would have significantly outperformed the S&P 500 during this time. Nice to note, the best score available, 99 on the dividend safety, very safe. And one of the reasons we love this company, they do tend to increase that dividend double digit year on year. And as we can see, 12% just last month. When talking about the valuation of UNH, well, our intrinsic value of $586, it does give some nice margin of safety. At 10%, a buy at 527, 15% around 498. And in today's episode, not quite at that 20% level. So right now in the market, you are looking between 15 to 20%. With Wall Street themselves seeing a forecasted price $582, they see 20%. Again, they do believe this is a strong buy, and this is also one, for full transparency, that we do hold in our own portfolio. Now, before we move to the next one as well, just to let you know, 12 minutes ago we've released our latest free weekly article, probably our favorite one yet. It does include a free Excel spreadsheet running through every single Dividend King. If you want access to this or any others on the channel completely free, you can read instant access by clicking below and subscribing straight away. The next one we're looking at is Paycom Software. Now, this one has been hammered down 55% over the last 12 months. Over the last 10 years, however, an incredible performance even after the drop, up 989%. And we can see all-time highs nearly 3 years ago sitting around that $550 mark. It is trading in the lower end, if not at the 52-week low. We do, however, get a triple hold rating across the board. yield on a trailing 12-month basis just over 1%, and a forward P sitting around 18.23. In terms of dividend safety, well, we don't have a score as of yet, as they just have started to recently pay a dividend. Now, when we talk about the valuation, we are getting to a price of $186, which isn't too far off Wall Street. In fact, they do see a nice 28% upside over the next year. And when we talk about margin of safety, well, 10% a buy at 168, at 20% at 149, not quite at that 25% mark yet, again sitting somewhere between a 20 to 25%. And if you do believe in this company over the longer term, we do see this as quite a high quality one where we have done deep dives recently. You are looking at 20 to 25% MOS with upside of 28%. As always, do let us know your thoughts about these stocks as we go through. We then move on to Snowflake, another company that is right there towards its 52-week lows, a double buy with a hold from Quant. Over the last 12 months, we can also see it is down around 17%. Now, they don't pay a dividend, so for this stock, we will jump straight into the valuation. Now, we get an intrinsic value of $161. Bear in mind, Wall Street believe this to be much, much higher over the next 12 months. Their price target indicates upside of 45%, indicating a very strong consideration for your portfolio. When we look at our own margin of safety at 10%, we believe that is where it's sitting right now in today's market. But as always, do your own due diligence and give us any of your thoughts below. We then move on to another one that has been battered. It is Estée Lauder, down 46% over the last 12 months. Over the last 10 years, it is up around 43%, but we can see it nearly 3 years ago, all-time highs, nearly 4 times the current trading price at $370. We have a buy rating, a hold rating, and a sell rating, as we mentioned, right there at the 52-week low. Forward yield 2.48%, forward P sitting at 47.5. Now, in terms of the dividend safety, it does sit at 60, borderline safe. Again, one that we did do a deep dive not too long ago. And what we can say is that it is currently offering the highest yield over the last 5 years, although they haven't increased that dividend since November 2022. Now, in terms of valuation, our intrinsic value at $138, it does give at least a 10% margin of safety up to 125, at 20% around 111, and in today's episode, again, not too far off a 25% margin of safety, sitting somewhere between 20 to 25%, with upside of 44%. They are seeing their price target $153. Again, another company that Wall Street do seeing have a large upside in comparison to our intrinsic value. We then move on to Suncor Energy, where we have that double buy rating, the hold from Quant, trading in the mid to upper end of the 52-week range, a 4.2% yield on a trailing with a forward PE sitting just above 9. Over the last year, very strong, up over 28%. Over the last 10 years, however, it is down around 8%, and we can see all-time highs sitting around that $41, $42 mark. When we talk about this company, while their dividend safety score is 50, borderline safe, again, let us know if you want to see any of these in a deeper dive, as we do run through a lot of their metrics. And when we look at their growth, nice to note, at least increasing just above that inflation in November 2023. In terms of the valuation, while our intrinsic value at $52, again, and when we look at that margin of safety, a 10% MOS, well, $47, 20% around $42, and in today's episode, you aren't getting quite a 30% margin of safety, not too far off it, sitting somewhere between 25 to 30%. We also see Wall Street do like this company. They do see upside of over 21%, and their price target does sit at that $46 mark, lower than our intrinsic value. We then move on to Zoetis, where we again have a double buy rating hold from Quant in the midpoint of the 52-week range, with a forward yield sitting around 1% and a forward P at just over 30. Over the last 12 months, well, they are up around 3%. Over the last 10 years, another one that has significantly outperformed the S&P, up 441%, and we can see all-time highs sitting just below that $250 mark. When we talk about the dividend safety, well, nice to see a safe score, 74, and they have increased that dividend at a very strong rate, 15% just December last year. Now, in terms of the upside, well, Wall Street see that 23% with their price target at 214, not too far off, in fact, our intrinsic value. And when we put it in terms of the margin of safety, 10% at least $191, 15% 180, so not at 20% just yet, but not too far off, sitting somewhere between a 15 to 20% MOS, with Wall Street clearly indicating a very good company to consider for the portfolio. This then takes us on to Papa John's International with a sell from Quant, a buy from Wall Street, and a hold from Seeking Alpha. We can see this right there trading right now at its 52-week low with a forward yield at 4.22% and a forward P just above 18. Now, over the last year, horrific performance, down 41%. Over the last 10 years, marginally up around 4%, as we can see all-time highs sitting around the $130-$135 mark. Now, when we take a look, they don't currently have a dividend safety score, but nice to note they did increase their dividend over the last full year at double-digit 14%. When we talk about this company, well, first thing that we have to make clear, Wall Street do consider this a massive upside, 60%, in fact, the largest of all the stocks, so we did save the best till last, and our intrinsic value does give this around $73. As always, we can take a deeper dive. Margin of safety, and this will be a massive margin of safety, just given the difference between both the current price as well as that intrinsic value. And at 40% MOS is pretty much where it is trading at today. So if this is one that you want to consider, right now we see 40% margin of safety based on our estimates and judgments, with Wall Street indicating upside of 60%, a definite consideration. As always, let us know your thoughts about these 8 stocks, whether or not you do see any of these being real contenders for the portfolio. And if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.